The AI bubble may not burst because artificial intelligence is fake. It may burst because investors are paying too much for a future that has not arrived yet. Right now, billions of dollars are pouring into AI. Companies are building massive data centers, buying record amounts of advanced chips, and spending enormous sums to stay ahead in the AI race. Wall Street loves the story. AI is the future. AI will transform every industry. AI will create trillions of dollars in economic value. And maybe it will. But there is one problem. The market may already be pricing in a perfect future. And when expectations get too high, even a great company can become a terrible investment. This is the real AI bubble debate, not whether artificial intelligence is real. It is. The real question is whether the money being invested into AI will eventually generate enough revenue and profit to justify today's valuations. Because right now, companies are spending billions of dollars on AI infrastructure, data centers, chips, cloud computing, energy, and advanced computing systems. But investors are beginning to ask a very uncomfortable question. When does all of this spending actually start producing meaningful returns? Imagine a company spending $100 billion on AI infrastructure. That sounds impressive, but the real question is simple. How much profit will that $100 billion eventually generate? If the answer is clear, the investment could make sense. But if the answer is simply, the profits will come later, investors may eventually start asking how much later. And that is where the risk begins. The biggest mistake investors can make is confusing a revolutionary technology with a guaranteed investment. The internet was real. But that did not mean every .com company was a good investment. Many companies disappeared, the technology survived, and the same thing could happen with artificial intelligence. AI could completely transform the global economy. And at the same time, many AI companies could still fail. Some will lose their competitive advantage. Some will spend too much money. Some will never generate the profits investors expect. And some may simply be priced far too high. This is why the next phase of the AI boom may be very different from the first. In the beginning, investors were focused on one question. Who is building the most powerful AI? Now the question is changing. Who is actually making money from it? Because eventually, every major technology trend reaches the same test: revenue, profit, and cash flow. If a company is spending billions on AI, but its revenue is not growing fast enough, if its cash flow continues to weaken, or if its future profits depend entirely on optimistic assumptions, investors may eventually lose patience. And when investors lose confidence in a high-growth stock, the decline can be extremely fast. This is especially important for the US stock market. A small number of major technology companies have an enormous influence on market performance. So if expectations around AI begin to fall, the impact may not stay limited to one company. It could affect the entire technology sector. And the timing matters. If interest rates remain elevated, if inflation stays above the Federal Reserve's target, and if energy prices continue to rise, investors may become less willing to pay extreme valuations for companies that may not generate significant profits for years. That is when the market can become extremely sensitive to bad news: a weaker earnings report, a slowdown in AI spending, lower profit guidance, or even a warning that the return on AI investment will take longer than expected. Any one of these could change the market narrative very quickly. So what should investors actually do? The answer is not to panic and sell every AI stock. And it is definitely not to buy every company simply because it has the word AI in its business strategy. Instead, investors should ask 4 simple questions. First, is the company generating real revenue from AI? Not just announcing an AI strategy, not just promising future growth, actual revenue. Second, is the company generating real cash flow? Because revenue is not the same thing as profit. And profit is not the same thing as cash. Third, is the stock price reasonable compared to the company's actual earnings? Because even an amazing company can become a bad investment if you pay an unreasonable price. And fourth, how much of your portfolio is exposed to the same risk? Because diversification matters most when the market is built around one dominant story. You can believe in the future of AI without putting all of your money into one AI company. You can be bullish on artificial intelligence and still be cautious about AI valuations. And you can believe that AI will change the world while recognizing that some companies will not survive the competition. So, is the AI bubble about to burst? The truth is, nobody knows. And anyone claiming to know the exact date of the next market crash is guessing. But one thing is becoming increasingly clear. Artificial intelligence may be one of the most important technologies in human history. But that does not mean every AI stock is a winner. The technology can be real. The opportunity can be massive. and the valuation can still be completely unreasonable. That is the difference investors need to understand. The smartest investors are not simply asking, is AI the future? They're asking a much better question. How much am I paying today for that future? Because when the hype eventually fades, the companies with real revenue, real profits, strong cash flow, and a sustainable competitive advantage will be the ones that remain. The AI revolution may continue for decades, but the biggest risk may not be missing out on AI. The biggest risk may be buying the wrong company at the wrong price because of the wrong story.